Now look, the Federal Reserve hasn't moved an interest rate in 5 months. 3 meetings in a row, January, March, April, all holds. And right now, most American homeowners are still waiting for the cut, waiting for the relief, waiting for the refi window everyone keeps promising is coming. But here's what nobody is telling them. The Fed already cut 3 times, 75 basis points total between September and December of last year. And today, 5 months later, the average 30-year mortgage rate sits basically in the same place it did before the cuts. The Federal Reserve, the only organization on earth that can furiously spin a steering wheel for 4 months while the car drives straight into a ditch and still expect you to clap for the driving. If you've been told to be patient, if you've been told the Fed is going to come to your rescue, if you've been responsible and you waited because waiting was the smart move, this is the conversation nobody at your bank or on the news is having with you, because there's a pattern playing out right now, a pattern we've actually seen before. And the homeowner who recognizes it this week versus the one who keeps watching CNBC for the next rate cut announcement, those two people are going to live in completely different financial realities by the end of the year. I'm going to show you the pattern. I'm going to show you why your mortgage didn't follow the Fed down, and I'm going to show you the 3 moves to make this week, depending on what loan you actually have, before the June 17th Fed meeting. Because that meeting is less than 30 days away. And what they say at that meeting is going to lock the next 9 months in place. Let's start with the pattern they're not explaining to you. You see, conventional wisdom says when the Fed cuts, your mortgage follows. And look, that wisdom worked great in 2008. It worked great in 2020. The world we're sitting in right now, different game. So what's actually moving your mortgage rate if the Fed isn't? Well, imagine you're driving a car. Your dashboard has 2 speedometers, one on the left labeled Fed funds, one on the right labeled 10-year Treasury. The whole world has been telling you to watch the left dial. CNBC watches it, your loan officer watches it, the financial advisor on the morning show watches it. Every time that dial moves, they make a face. Big news. They trot out 4 different guys in quarter-zip sweaters to stare at a dial that isn't plugged into anything, nodding very seriously about what it means for your family. Well, here's what you're missing, thanks to them. So if you're in the driver's seat, the part wired to the actual speed of your car, which is your mortgage rate, that's wired to the dial on the right, the 10-year Treasury, not the Fed funds dial on the left. You can stare at the Fed funds dial all day. The car doesn't slow down when it moves. The car responds to the other dial, and the other dial is being moved by people you've never thought about. Global bond investors, looking at inflation, looking at how much debt the US government is selling every week, looking at oil prices when there's a war in the Middle East. This isn't a theory. The Federal Reserve Bank of St. Louis has the data going back 50 years. Mortgage rates track the 10-year Treasury about 85% of the time. The Fed funds rate, maybe 50% on a good year. So while you've been watching the dial on the left, here's what was happening on the dial you weren't watching on the right. While the Fed was cutting, the 10-year Treasury was going up. Tariffs raised inflation expectations. Treasury supply hit records as the government kept borrowing. Operation Epic Fury in February spiked oil. The bond market priced all of it in. The Fed cut the left dial, the right dial climbed. Your mortgage rate didn't follow the cut, it followed the climb. But I noticed something else. The Fed actually told us this was going to happen, out loud, 5 months ago, at the December 10th press conference, the same press conference where they cut for the 3rd time. Powell said 2 things at that meeting that translate cleanly, if you know what they mean. First quote, "We're in the high end of the range of neutral." Only a central banker could use 8 words like that to tell you they're abandoning you without actually using the word abandon. Plain translation, rates are staying right here. Second quote, "We are well positioned to wait and see how the economy evolves." Translation, we're done cutting. And then the Fed published its own dot plot, the chart showing where each Fed governor expects rates to be over the next 2 years.
The appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027.
The dot plot from the December meeting showed 1 cut in all of 2026 and 1 cut in all of 2027. The Fed publicly told American homeowners, "We are not going to save your mortgage rate for the next 18 months. They said it on camera. They wrote it down on a chart, and almost nobody translated it into English for you. Because apparently, translating the most important financial document of the year wouldn't leave enough time for the morning shows to do their segment on the top 5 air fryers. The Fed didn't ambush you. They warned you. The warning, it just came in Fed speak, and the people who were supposed to translate it for you instead told you to be patient, which is like watching a meteor heading for your house and the weatherman telling you to just sit tight and wait for the cooling trend. So, what does happen next? Well, I don't have a crystal ball, but here's what happened last time. Not the 2008 kind of last time, not the COVID kind of last time. No, picture this last time. It's 1971. Mortgage rates are about 7.5%. Inflation is creeping up. Oil prices are about to triple. And the Federal Reserve, under pressure from the White House to support employment, starts cutting rates. The homeowner of 1971 thinks, this is my window. The Fed is cutting. My mortgage rate, it's going to follow. The Fed cuts rates again in 1974. Mortgage rates now 9%. The Fed cuts again in 1976. Mortgage rates 9%, climbing towards 10. By 1979, 8 years after the 1971 homeowner first thought, I'll wait for the cut, mortgage rates hit 11.2%. Per Freddie Mac, per bank rate, the cuts never came. Every time the Fed eased, the bond market repriced higher because inflation expectations stayed sticky. Inflation expectations stayed sticky. That's the system's favorite euphemism for we printed too much money and now your groceries cost double, but we're going to make it sound like it's the inflation's fault for sticking around. The homeowner who waited in 1971 for rates to come back to 6%, they didn't see 6% again until 2003, 32 years later. Now look at what's true today. Sticky inflation, tariffs feeding into prices, record Treasury supply, a weakening labor market, and a Federal Reserve that just cut 3 times while mortgage rates went the wrong direction. You're not sitting in 2008. You're sitting in 1972. And the homeowner sitting next to you is making the exact same mistake the 1972 homeowner made, waiting for the dashboard you don't control to fix the problem you do. Staring at the Fed funds dial like it's a microwave counting down, while the kitchen quietly burns to the ground around them. So if mainstream advice is wrong, and the historical receipt confirms it, what are people who don't watch CNBC actually doing right now? What's the smart money playing? Well, I keep coming back to 3 moves. 3 moves the sophisticated homeowners I know are running while everyone else waits. Move 1. Wealthy homeowners with sub 6% fixed mortgages are not refinancing. I mean, why would they? They've got a 3.2% loan in a 6.4% environment. Inflation eats their loan balance every month while their payment stays fixed. They may be recasting instead, but not refinancing. In case you didn't know you could do this, from my experience, most homeowners don't, but here's how recasting works. Here's what it is. You make a one-time lump sum payment toward your principal, say $25,000 sitting in your money market doing nothing useful. The bank then re-amortizes your loan. Your monthly payment goes down. Your interest rate stays the same. Your term stays the same. Closing costs on a refi, $6,000 to $15,000. Recast processing fee, $150 to $400. No appraisal, no credit check, no new loan. You see, the bank doesn't promote it because there's no commission in it. Your loan officer doesn't mention it because his job is selling refis, but it exists, and the 1% is probably taking advantage of it right now. Move number 2. Wealthy homeowners with ARMs are likely converting to fixed before the reset hits. Not at month 60 when the adjustment letter arrives. At month 56, maybe 55, they take the certainty of a 6.4% fixed over the cliff of an ARM reset that could land at 7% or higher. If this is your situation and you're looking for a resource or a place to start, you go ahead and check out who I use at houserichcashready.com. Move 3. Now this may sound like I'm contradicting myself, but no. Wealthy homeowners, they still may do cash out refis at 6.4%, counterintuitively. Why would they do this? Well, because they're pulling equity to deploy into rental properties earning 7 to 8% cap rates. They're not refinancing to save money on their primary. They're refinancing to access capital to deploy. Refi applications were up 81% year over year as of the latest data. That's not retail panic. That's sophisticated money taking spread while it's still available. You know, my buddy who closed on his 4th rental last month, he didn't wait for the Fed. He pulled cash out at 6.5%, bought a single family in South Carolina at 8.9% cap, and has been pocketing the spread every month since. That's what playing offense looks like. So 3 moves, 3 different loans, 3 different plays, 3 completely different outcomes, and none of them involve waiting. So let's be honest about what's actually happening here. I mean, imagine your spouse asks you tonight at the kitchen table, after dinner, the way these conversations actually happen. So what do we actually do about our mortgage? You should have an answer ready. Not a guess, but a real answer, because when they ask, the ball will be in your court. So here's what to do this week. Before the Fed meets again on June 17th, before the next round of headlines tells you to be patient, there are 3 plays that you can make. Play number 1, open your loan statement. 5 minutes maybe. Find 3 things: your interest rate, your loan type, fixed or adjustable, and your remaining term. Most homeowners can't tell you those 3 things off the top of their head. You cannot make the right move without knowing what loan you have. So pull the document, read the first page, 5 minutes. Play number 2, match the tool to the loan. If you've got a sub 6% fixed loan and idle cash sitting in a savings account, call your servicer. Ask if your loan is eligible for a recast. FHA, VA, and USDA loans are not. Most conventional loans are, though. 1 phone call, it's all it takes. If it's a fit, great. Now you know. If it's not, hey, that's fine too. Either way, knowing your options, that's a win. Now, if you got an ARM, an adjustable rate mortgage, with the reset coming in the next 18 months, get 3 refi to fixed quotes this week. 3 lenders. Really consider locking something in before June 17th. The cliff, it doesn't wait for you to feel ready. Play number 3. If you've got 25% equity and you're ready to play offense, not defense, pull a cash out refi quote. Run the spread first between the new rate and the cap rate on a turnkey rental in a market where the math still works. If you need a starting point for that, download the playbook at inflationdefense.com. For free, they can walk you through exactly what the math looks like and where the deployable inventory actually is right now. Link, it's in the description. 3 moves, doable this week. Listen, the Federal Reserve didn't fail you. The advice did. You were told to watch a dial that was never connected to your car. And history is telling us that you have 30 days before the June meeting decides whether your refi window is still open or whether the cliff catches up to you first. I wish I had that crystal ball for you, but I shared with you the next best thing, a history lesson. Here we go again. And there are 2 roads to choose from. Road 1, keep waiting. Trust the advice you've been given for 18 months. Wait for the cut that the Fed already announced isn't coming. Watch the wrong dashboard for another year. And in 3 years, when mortgage rates are still in the 6s or higher, and your home equity is locked behind a refi math that doesn't work, you're going to be the 1972 homeowner. And if you're okay with that, so am I. Or you can choose road 2. Open your loan doc this week. Match the move to the loan. Take 1 concrete action before June 17th. That's the play. Now, I gave you the recast move today because it just kind of fit the conversation that we were having. But recast is just 1 of 5 things your banker isn't supposed to tell you about your mortgage. The other 4, that's why I pulled this video out here for you to watch next. I sat down a few weeks back with an actual mortgage statement and walked through all 5. What they are, what they cost you, and which ones you can turn off this afternoon. Pull yours up while you watch. A couple of these you're going to be mad you didn't know about sooner. God loves you, and so do I. Take care.